My name is Joe Dillon, and we're going to spend a little bit of time today talking about the intersection of power markets and Bitcoin mining. And I think it's going to be pretty interesting. I want to introduce our two excellent panelists today, McDonald from Foundry, drum roll style, yeah, and Chris O'Donnell from CWP Energy. Hey, Chris. I see we swapped the energy guy and the miner guy attire today, huh? Is that what we're going for?
By design.
Yeah.
Trying to break the mold.
Well, to kick off a little bit, why don't you give us a start here, Chris, and just give a little bit of background about who you are, and then we can have Cam do the same, and then we can kind of go from there and talk a little bit about some of the work you guys have done so far, and then we can kind of dive in a little deeper.
Yeah, that sounds good. So I'm Chris O'Donnell. I help head up the client-facing business called CWP Energy Solutions. And CWP Energy Solutions is the sister company of a power trading company that founded in 2012, mainly focused on renewable intermittency and nodal trading. And so what we do on the client-facing side is we work with generators and we work with loads, and we're looking to optimize the dollar per megawatt hour equation. So for the generators we work with, we look to optimize their dollar per megawatt hour sales to the high side. And for loads or miners, as we're talking about today, we look to optimize that dollar per megawatt hour on the cost purchases of electricity to the downside. And we look to basically structure a value add component. So we always align financial interest as a win-win or a loss-loss, and look to structure all of our partnerships that way.
Awesome.
Yeah,
Cam?
so I work for Foundry. A lot of you guys out there probably know Foundry from the pool, but we are a miner ourselves. We're an ASIC brokerage, miner service provider, and then we also have a staking hardware side of the business. And on what we're talking about today, Foundry just realized that, coming into the next cycle, and it really started almost over a year ago, that we need to get more energy intelligent just due to the input cost that goes into our business. And that's kind of what brought us together to, seek out some help and talk to CWP to just get educated.
Yeah, I think that kind of these relationships start, more around data and conversations, and kind of proving, how our expertise can help augment Cam's team and Foundry, and kind of take that and see how we start to synergize, and you start to realize there are quite a few more synergies that you really plan for, and the rest is kind of history, as they say.
Yeah, so let's dig into that a little bit. So I think it's pretty clear to most people in the mining space that both power and mining are both very complex businesses. They're capital intensive, they're operationally complex, and it's hard. I think I heard on the last panel, it's the worst business in the world, and I think power people may disagree at times and say the same. So we have these two very complex business models that are beginning to intersect for the first time. We're just starting to see those synergies. There was a study, I think, by Barrett in 2019 that said by the end of this decade, we're going to need over 200 gigs of flexible load. And that was before Build Back Better, that was before the infrastructure bill, and that was before the IRA. And so I think I saw out in the conference hall that the estimate today is there's like 12 gigs of Bitcoin mining. So we're talking about like a pretty material growth there, and it feels like there needs to be a way for the power markets and the mining markets to more efficiently communicate with each other. Cam, what are your thoughts on that?
Yeah, so where Bitcoin miners and the energy section meet, I think there's a lot of education that needs to be done on both sides. And I think through the conversations we've been having with CWP and other companies, we realize that it's very opaque when the energy companies are looking into our space, and it's a lift for them to learn. And they need help being educated. And as a Bitcoin mining company and your OpEx being driven by your input cost of energy, it's something that you need to be educated on as well. And I think the industry as a whole is starting to realize that. And we're just starting to see like the bridge of translation coming together between the two spaces.
Chris, what are you thinking? What are you seeing on your side? Like, what's the current attitude? Is this a new energy asset everyone's excited about? Is everyone scared? What are the worries? And how do you kind of reconcile that? And where's the market today in your view?
Yeah, I think when things are new, everyone's always scared. I think from our side, when you have things like the Inflation Reduction Act or subsidies that are flowing and even private capital that's flowing in, and the whole goal is to push the green agenda, build more wind, build more solar, build more battery storage. These subsidies and capital, need to find a home. And a lot of times in the windiest areas of the country or the sunniest areas of the country, a lot of these renewables are building on top of each other. And in order for them to get built, they need to get financed. And in order for them to get financed, they need to have a power purchase agreement in place. And that power purchase agreement can come from a bank, it can come from a utility, it can come from a lot of the corporates that we see who've made promises on the ESG side to their shareholders. And they'll buy that power for 15 years, but they're not going to buy it at the site. They're going to buy that power at a liquidly traded hub that they can, work and put their hedges in place. So that starts to create price dislocations, which is referred to as basis risk. And that's
I hear you love basis.
Yeah, I guess we do love basis, but at a energy conference, basis is a very provocative, and this is definitely meant to be provocative at an energy conference because it's usually a pain in everyone's side. But on the mining side, we see it as an opportunity. So for the generators that we work with, we look to input our trading strategies and our hedging strategies to help them manage those cash outflows better. But a lot of the places where you have an overabundance of renewables, there's not going to be a silver bullet transmission line that comes in and saves you. You need to work with controllable loads. You need to work with miners to create a long-term solution to a long-term problem. And that's how we've gotten involved in the space. And I'd say 12 months ago, when we talk to our clients, they say, that sounds great. We don't want to talk about it again. Now, when we talk, those same clients say, let's do this. What are the hurdles for us doing this? Let's meet these miners that you've been working with and let's have a face-to-face conversation. And we're not going to get the first contract right. I mean, maybe not even going to get the second contract right, but it's being transparent and, talking through those issues and coming to like a homeostasis so that, both parties can get, what they want at the end of the day.
So it feels like there's starting to be those first moves of reaching across the table from the energy side, and I think I've seen that happen recently as well. Cameron, you beginning to see on the mining side a little bit of like that reset of expectations happening where like you're going to be trading some uptime because at times it's going to be a higher economic value to curtail than it is to run. Are you seeing that understanding from the mining side starting to seep in, or you think there's room to go?
I think there's room to go, not to say that it's not being realized. I think what we've seen over the past year in the mining space has been a dislocation, not of basis, but of cap sheet, and people using seed money, VC money, or public market money to raise capital for their ASICs and their infrastructure and trying to get the cash out as quick as they can. And now, when you're doing that, it puts all the pressure as a mining company to get your maximum uptime. You got 99.9% uptime in some of these locations. And I think with energy trading strategies and the education coming into the space around energy and what's available in different markets, people are starting to see that you may not need that uptime. If you have positive control of your energy and the right strategy, you can sell some of those kilowatt hours back to the grid and still make money in that time that could be considered downtime. Or you take a different approach and you look at a little bit more downtime for a lower input cost across all your uptime. And I think those strategies are starting to play out for people.
Do you feel that there's more sophistication today so the way I look at this is it feels like there's kind of two potential trades there, right? One is kind of your regulated demand response trade, you can call it, where you're enrolling in a program and you have a fixed, economic expectation, and the other one feels a little bit more volatile, but also potentially more impactful on, using the power markets, effectively to do the same thing synthetically. I want to hear from each of you on this, but like, where do you see, in general, the sophistication level today? Are miners doing no DR? Are they doing DR but no kind of economic management? Are they doing a little bit? Where on that spectrum are you seeing miners today? And like, where do you see that kind of rolling forward here? And Chris, why don't we start with you and then we'll go to Cam.
Sure. I've been very impressed with the sophistication from miners. And when we first engaged in these discussions, the learning curve is steep, but the education that miners have and their ramp up in sophistication is, parabolic. And you see a lot of energy companies, especially ones that have been around for many, many years, they do the same things, they have the same contracts, and if you don't fit into those contracts, well, they're not going to want to do business with you at the end of the day. Where on the mining side, the contracts and things that we've structured are brand new, and we put the contract together, the miners say, hey, this works for us, this doesn't work for us. There's a transparent flexibility, and then there's ability when risks shift one way or value add shifts another way, we can go back and say, hey, this was working well in this market environment, but it's not working well in this market environment. And fortunately or unfortunately, everyone got a crash course on the cyclical nature of power markets and Bitcoin markets last year. And the miners that have come through that, you really have to tip your cap to them, and that really holds people's feet to the fire and say, hey, we need to ramp up our energy expertise. And what we want to do is structure partnerships with miners who think similarly to us, use data similarly to us, and aren't afraid to be creative and flexible on the contracting side. So that's where I think we are today, and I certainly see that advancing even more so in the future, because energy companies are going to want to come back and have miners solve some of their basis or curtailment issues or help finance some of their projects by being that fixed price power off taker. And it's up to us, power trading companies, to say, hey, we have a lot more as generated resources on the grid that are selling fluctuating volumes at fluctuating prices. Power trading companies need to stand in the middle of that and be that catalytic converter to a miner who needs a fixed volume at a fixed price. And hopefully, if we do our job right, we put some premium in there where we can hedge out times where prices are, $2,000, $3,000. And if we're not doing that and we're not having a flexible, open conversation, then nothing is going to change. The stigma that some of these energy companies have placed on mining, I think, isn't going to change. So we do that with data and education and putting out material so people can actually learn about what we're doing and why it will help them in the future.
Yeah, on that note, I think the crash course in 2022 through the high price environment that we saw was an eye-opener for many mining companies. And I agree with Chris, like anybody who rode through that and is still out there hashing, good on you. I think there's a lot of work to do on the mining side, and I think the miners realize it, and they're actively taking steps. And like Chris said, it's about setting up relationships and partnerships with the right parties so you can bring that expertise that a CWP may have in-house and start using it to make better decisions, where your site's located, how you're going to optimize that site. And then moving forward in the contracting talk, mining load doesn't fit the general norm of energy origination that Big Energy Co. has been doing since deregulation came about. So there will be education that's needed on their side to actually get into this space in a meaningful way. But the companies that can help bridge that gap are the CWPs of the world. They speak that language, and they've come in and learned about mining. So when you're looking at that, it is the flexible nature of these contracts and these relationships. I think if you can be commercial and you can work through the little details that come up that maybe you couldn't foresee until a market event happened, the more we see some of that and the more cycles of that, and then you start reaping some of the benefits of those contracts and hedges. Nobody thinks about hedging until it's too late.
Prices back, right.
So the more proactive the players, the miners get in managing their energy, whether it's an active strategy or if it's a fixed price power and someone is on the backside optimizing it, I think that really helps the stigma start to clear. We had times in the 2016, 2017, 2018 where the early North American miners, some people came in and took power contracts and left, And it might not be as clear cut as that, but that's what makes the headlines and that's what sticks in the utilities' minds.
Yeah.
And for a Bitcoin miner, that was a century ago. For an energy company, that was last week.
Right. Yeah, that time preference is, I think, something both industries are still trying to work their arms around, for sure. And maybe we can use I'd love to use a more concrete example of something kind of we know is coming. So, Texas has put on 4 gigawatts of solar since January 1, right? So the forward markets are already pricing in that duck curve coming to Texas within the next probably 12 to 18 months. And for the non-power geeks out there, a duck curve is essentially when you have a lot of solar in the middle of the day and it's pushing you have over-generation essentially, so your prices get pushed way down. And what are some high-level strategies that miners should be thinking about knowing that is coming? And I think it comes into both how they should think about siting as well as transacting. And I think those are going to become pretty linked in this specific example. But I'd love to hear Chris and then Cam.
Yeah, when you really strip all of the complexities away from the power markets and from mining, in the end, unfortunately, whether we like it or not, we're all kind of beholden, if we're focused on renewables here, I should preface, to tax equity. Tax equity or the large banks or large utilities that need the tax credits to offset their taxable income. And so they invest a tremendous amount of money, and there's not many players in the space to monetize those tax credits. So at the end of the day, they're very, very risk averse. They need their tax credits to be coming in and offsetting those revenues. And if you have a bunch of solar farms or a bunch of wind farms all in the same pocket, eventually on days of high wind and low demand, the market's going to start sending negative price signals, -30, -40, telling those wind farms or solar farms during those duck curve periods to shut down. The problem is once they shut down, they're not producing that precious production tax credit, and that corporate off-taker that made ESG promises to their shareholder isn't getting their renewable energy credit. So if you're able to go in and cite either a financial hedge or, more importantly, cite a mining operation or a controllable load to go and say, hey, we'll pay you $10 or we'll pay you $5 and buy your energy from you. That helps the miner achieve a lower cost of energy, and that keeps that solar farm generating its production tax credits to satisfy the tax equity investors, to satisfy their corporate off-takers, and it helps them survive amongst other renewable assets in their area that are more or less forced to shut down and not able to monetize. So when that company goes to build its next asset, who do you think those investors are going to turn to? Companies that have been open, working with miners, helping generate more of these credits for them, and that type of capital is very competitive in today's market.
Cam, do you have any thoughts on it?
Yeah, and I'm going to tie in kind of the controllable load discussion with
Great.
that. When you're talking ERCOT specific, we have a resource that I think has been in the early stages of proving that it is a true flexible load for the grid. And now you have a big need for flexible load already in West Texas, South Texas, and that need for that load is only going to increase.
Yeah, I think additionally there, we've got the IRA that hasn't even really begun hitting yet. It's still kind of being finalized and moving forward. So that's the next landslide of investment, I think, that's coming in the space. I was at a conference last week. I believe Chris may have been there, but I believe that I heard almost every major developer there speaking about how they're thinking about having flexible load as part of their siting plans. And so that's super interesting, and that shows kind of where Chris is saying it's coming across the aisle. Now it's like, where are the miners going to be able to reach out and get into that flow? Because we do, to go back, have some time preference challenges where miners are typically, when they want to site, they want to go right now. And I think it feels like there's an opportunity there, Cam. What are your thoughts?
Yeah, I think, from both ends, big energy is slow. Mm-hmm. And you're talking about hundreds of megawatts per site on some of these solar and wind farms That takes time. That's real infrastructure. Throwing down some containers might take 6 months, soup to nuts. But we need to kind of start looking up at the horizon as an industry, as miners, and really start making strategic plays on where we're siting, who our partners are going to be on that, and thinking about both the energy optimization, the opportunities based on where a lot of this new IRA development starts. And I don't think it'll be just Texas. And you're going to see, nodal dislocation or basis appear in other markets as well. And maybe some of those markets are attractive to miners to kind of diversify out of West Texas, as there's been a lot being built out there. And then from the other end of that, on the controllable load side, like you mentioned before, there's definitely miners out there who are taking advantage of structured demand response programs, whether it's PJM, ERCOT, or NYSO. There's others that are on interruptible load rate classes with utilities and taking advantage of that. But I think what we're starting to see, and miners were forced to do it, was economic curtailment. And then I think miners, the next step for them, the most logical next step is the energy optimization. So instead of just curtailing, now you're also selling those kilowatt hours. So it's still revenue on the books.
Yeah, I agree. I think, and Chris, where are you seeing that on the kind of the IRA impact flow through? Do you think we'll see that geographic shift a little bit? What's your current view there?
Yeah, I mean, what we see is obviously there's many areas of the country that either have a lot of solar or a lot of wind. It's more, Texas has been very favorable in transacting and getting deals done. But when we look to the middle of the country, you see there's a ton of wind right through the mid-con of the country. And when we go to do similar deals with miners and the generation assets that we have on board, the generation asset wants the miner there, the miner wants to be there, the economics make sense. But then we go to some of the utilities or some of the co-op areas, and they say, well, this is adding to my net peak load, therefore I'm going to have to build new generation to offset this additional load growth, or we haven't changed our rate structure in 30 years. This is how it works. Just fit into that rate structure. And what we're saying is, well, we're not going to add to that net peak load, and we're not going to, work under that current rate structure because it doesn't work for what we're doing. But what is happening in these areas is a lot of these wind farms, the economics, once their tax credits roll off, they're distressed. They're in the red. And what's happening is we look across the street, more renewables are being built in this space. So what do you think is going to happen to price? So we need to start using some of the examples that have worked and different rate structures that have worked in other areas of the country, and kind of going to some of these, utilities and co-ops that are a little bit behind on things and saying, hey, this is what can help you. It can help generate taxable income for your communities. It can help rebuild some of the transmission system around you. And this is also something that can help benefit, the infrastructure of the transmission grid, which is obviously a huge issue. And I think the other thing that we see from the mining side is that the mining operations are getting more and more sophisticated. The CapEx that's required to build some of these sites and the investments that they make on the transmission system, which are super valuable, are extremely high capital costs. So if power prices change and they go from the low environment that we're in now and get back into the high environment that we're in 2022, well, the miner's not just going to be able to pick up and leave. So that's why structuring partnerships between power companies, risk managers, and mining and controllable loads is so important, because you need expertise in the markets to get through periods of high power, high gas prices, and low Bitcoin. So that's what we really look to try and create and say, hey, mining might be favorable right now, but things could change in your area, and what are you going to do when those things change?
Absolutely. And I think we're kind of ticking down here a little bit. I want to get some parting thoughts from each of you here, and I want to focus on that last bit, Chris, on transacting, because we've seen some activity come back into the market. You're starting to see some transactions start to take place. And so same question from different perspectives. Cam, what advice would you give to miners about how they should think about transacting if they really want to get something done? And then I think probably the same question from you, Chris, from your side of the table is like, what advice would you give if you want to actually get some transactions done? Because there's multiple parties.
Certainly.
Yeah, so on that note, I would say for the miners, like expand your time horizon. This isn't a next 18-month play, and it might be, cyclical, but you want to be out there longer. And if you can create the relationships with these power companies, these are companies that are almost dynasties in nature. So some of these companies, these big utility companies, are the ones who are backing the renewable projects. So they do have a vested interest in keeping the projects producing their PTC, collecting their ITC when they get built. And they're going to need flexible load, or else it's just not going to work. We don't have billions of dollars as a country to spend on modern transmission upgrades, and what we do spend on transmission upgrades won't be a drop in the bucket. So it's going to be Bitcoin miners taking on a lot of that load, and I think we're going to start seeing a lot of co-location at sites of generation to help address the basis change. And you might even see co-location of technologies. There might be energy storage and Bitcoin mining, depending on who the project partners are. There might be hydrogen production going on, depending on if that catches, a good tailwind. But I would say expand the time horizon and really start thinking about this in like a commercial relationship manner. And I think there's a lot of partnerships that'll kind of come out of the next 12 to 18 months in this space.
I think that's really good advice, Cam. Chris, what do you think?
I think from our side, it's about changing those historic energy contracts, but the energy companies aren't going to be the ones to change. I think it's on us to create partnerships and build those contracts together. And when they get wrong, or if something happens that maybe wasn't thought about when the contract was put in place, let's have a discussion and find out what works and what doesn't work, and then use those contracts that we've hashed out all of this risks or issues, and start to try and replicate them and work with energy companies. So for us, kind of as a middleman, although we're on the energy company, we try and be a little bit of a bridge and go to the energy companies that are these large incumbents and say, hey, this is what's been working for us. This is how we've addressed certain issues. And kind of the problem that we saw in 2022 was that some of these large energy companies, love the miners coming in because of how it, shows up on their cash flow statements, on their balance sheets, all of the money that's coming in, they love that. But what they did, and knowingly did, was they passed a lot of the market risks onto the miners. And when Bitcoin's at 65K, that's fine. No one's really worried about those type of risks and what it means. But when you have a power market like we saw last year, those risks become material, and they put a lot of pressure on the balance sheets and cash flow statements of miners. So it's making sure that people understand the risks, they understand the mechanisms for addressing the risks, and then when a contract starts to go sideways or there's been issues, it's up to us, everyone in this room, to kind of work together so that from all the other energy companies that have thought about mining or thought about looking at controllable loads, they can take a look from the outside and say, hey, this is a pretty friendly contracting space. People are flexible, people are creative, they want to do business. But if there's a lot of infighting or times where there's high stress and there's winners and losers coming out every single day, and a lot of the energy companies that want to get in the space are going to be scared. And I think that's the example that we need to show, and I think that's why it's been pretty impactful for us working with transparent partners that are able to think through, and every single contract we make gets better and better and better. So that's kind of my advice and what we want to focus on and set a good example for everyone in this room, but more importantly for the folks that are outside this room that want to be in this room.
I think that's really well put, Chris. And to tie us out here I think that's the great takeaway: is expand your time horizons, have some flexibility with your partners, be transparent, and you're going to have to get creative. But you're going to be going in as a team, and I think we're going to see some of those teams getting built here pretty quickly. So really appreciate you guys coming up today and sharing from both your perspectives. I think it's really helpful. I think that That's going to bring a lot to the space. I think there's more to talk about here, and it's going to continue to broaden the conversation as we move forward.
Definitely.
Definitely.
Thanks, Joe.
Thanks, guys.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.